Hello, everyone. Welcome to video 3 on chapter 21. So before I was talking about what constitutes a supply and how is it collected, I'm going to talk in this video about when do you register to collect sales tax. So sales tax is to be collected by anyone partaking really in any sort of commercial activity. So this business could be run by an individual, a partnership, a corporation, could be run by an estate. So if I have a business and I pass away, but that business still keeps going, then the future revenues will be collected by my estate. A trust, a body that is a society, union, club association, commission, or any organization of any kind. So this also includes charities. So when we talk about taxable entities, there's three major taxable entities: individuals, corporations, and trusts. But when it comes to sales tax, really anyone who carries on a commercial activity may have to collect sales tax. A person's required to register if they are providing taxable supplies in the course of a commercial activity. Exemptions may be a small supplier. Only commercial activity if person is making of supplies of real property. So since real property is exempt, if your business is exempt from sales tax, then you don't need to register to charge sales tax because you never will. Non-resident, or you never will be charging it. A non-resident person who does not carry on business in Canada, if we only have to charge sales tax for business being carried on in Canada. So if a non-resident has a business outside Canada, they don't need to register with Canada to charge sales tax. Registration is required when taxable supplies are delivered in the course of commercial activity. Do we get into the, kind of go straight into the, oh, there is exemption for small supplies. Okay. So registration is required when taxable supplies are delivered in course of commercial activity. So even if your supplies are zero rated, which means no dollars are ever really going to be collected, but in order to claim the ITCs on your sales tax returns, you need to be registered for sales tax. So I won't be charging sales tax, but I'll still be paying sales tax. And I will still want to get that money back from the government. Registration's not required if a business is carried out without reasonable expectation of profit. If it's something you do for a hobby, child care services is an exempt supply, or any exempt supply. So it was mentioned here that, real property is generally exempt. So you don't have to be registered, because if you're only applying exempt supplies, you're never going to be charging HST, and you also don't get to claim the ITCs. So your returns are always just going to be zero. So there's no point in registering if you only provide exempt supplies. And provision of employment services, but that's partly because employment services are exempt. In general, the requirement to register excludes non-resident, but does not apply to a non-resident who carries on business in Canada. So there's kind of a few double negatives here. Basically, sales tax applies to businesses in Canada. If you are running a business, if you have customers in Canada, you need to charge their sales tax. A non-resident with a permanent establishment in Canada is deemed to be a resident of Canada for the purpose of sales tax registration. The concepts of factual residency goes back to chapter 1. I'm not going to revisit them here. So it mentions that small suppliers don't need to register, but how do we know if a supplier is too small for registration? They use a sales threshold of $30,000. So revenues before expenses from taxable supplies are less than $30,000 per year. And they don't just base it in a per year basis. They use 4 continuous quarters. So let's say a company makes $20,000 in one year, $20,000 in the next, they wouldn't need to register for sales tax. But if they earned $20,000 at the end of one year, say in the last quarter, and then they earned another $20,000 in the first quarter, combined, those quarters are $40,000. Now we're over the threshold. So they don't just look at a calendar year, they look at 4 continuous quarters. If those 4 quarters ever reach over a $30,000 threshold, then you need to register for HST. Association rules apply to threshold individuals who alone or together with associated person controls a corporation would be associated with that corporation. So if I have a company that's going to make $50,000, I can't just break it into two businesses and say, well, don't need to register because now they both only make 25. They look at the associated businesses, say, no, combined they make 50, so you still need to register. Even if your income's below 30,000, you can still voluntarily register. And someone might want to do that because they might be paying a fair amount of ITCs. And if they want to be able to claim those tax credits, they need to be registered. So perhaps I'm in the early days of my business. Right now, I'm not earning much income, but I'm investing a lot in, say, inventory. So I'm buying a ton. So my ITCs are really high, but my revenues are really low. Well, I can't claim those ITCs unless I'm registered. So I might want to register anyway, file those HST returns for a small amount of revenue, but try and get those ITCs back. So you can voluntarily register if you want to, even if you're not yet at that threshold. Certain taxable suppliers are prohibited from exemption: taxi services, commercial ride sharing like Uber, amusement carnivals, and seminars. So the reason something like an amusement or a carnival is that's a seasonal business. They only set up in the summer and then they leave. So it's hard to use that 4 continuous quarters because they only operate for, say, 1 quarter a year. So they cannot be exempted. They still have to report and file their HST returns. So like I said, we use the last 4 quarters test. So we must register if any 4 consecutive calendar quarters reach that $30,000 threshold, ceases to be a small supplier at the end of the first month after the quarter in which $30,000 was reached, deemed registration date on first sale made after the additional month, actual registration required within 29 days from deemed registration date. So those were just fancy ways of saying once you've hit $30,000, you need to be registered within the next month. So you cease to be a small supplier at the end of the first month of the quarter in which $30,000 was reached. The first month after the quarter, sorry. So if a first quarter ends March 31st and you've reached over 30,000, you need to be registered before the end of April, that first month of the next quarter. So we've gotten to the end of the quarter, we've hit our threshold, we have 29 days to get registered. Maybe in 4 consecutive quarters, we never hit 30,000, but in the calendar, the calendar quarter test is when we look at the last 4, maybe we're not over 30,000, and then in one particular quarter, we hit $30,000. Well, you're a deemed registrant as of the first sale after $30,000 is reached. So if we hit that 30,000 threshold in a single quarter, we have to register within 29 days of that sale instead of being able to wait until the end of the quarter to determine it. So let's look at the exercise for that. Exercise 21-2, requirement to register. Miss Sharon Salome and Mr. Rock Loughton begin separate businesses on April 1st, 2024. The quarterly sales of taxable supplies for both businesses are as follows. So here we have 4 quarters. Sharon earned 10,000 in one quarter, then 4,000, then 35,000, then 40. So she had a couple small quarters, and then she hit those thresholds right away in a single quarter. Rock was a little slower with his growth. It was 8,000, then 13, then 4, then 17. So Rock, we can't see outright whether or not he's hit that $30,000 threshold. So we'll keep track of that. But for Sharon, we can see she hit $30,000 in one quarter. She's got to register. But when does Miss Salome and Mr. Loughton each begin to each have to begin collecting sales tax, at which point will they be required to register. So looking at their sales amount, we have to track up on their quarter. So starting with Sharon, we'll look at the cumulative sales of the last 4 quarters. We start with 10. When she earns the next 4,000, cumulatively, she's earned 14. So she's not at 30,000 yet. And then in the third quarter, she hit $35,000 in 1 quarter. So she needs to register within 29 days of that sale that got her over the 30,000 in the quarter. Cumulatively, she's well over 30,000 at $49,000. So because it was such a big quarter, she can clearly see I've hit 30,000. So I need to register as soon as possible. We have 29 days, and then we'll have to collect sales tax. January to March, she's had another 40,000, but by that point, she should already be registered and collecting sales tax on those sales amounts. Now, Rock is a little slower. He has 8,000 in the first quarter, 13,000 in the next. So cumulatively, he's still only at 21,000. The third quarter was only $4,000. So he's only at 25. So far, he hasn't even hit that $30,000 threshold. So he's not required to collect sales tax yet. He had kind of a good quarter for him, $17,000, which got him from 25 to 42,000. So the sales amount wasn't 30,000 in the quarter. So there's no need to immediately have the 29 days. But once we get to the end of the quarter and we look back, well, now we see that that $42,000 is over 30. We see that our cumulative amount got over the 30,000. So that quarter ended March 2025. So we have basically another 29 days until the end of April. So the first sale on or after May 1st needs to have GST applied to it. So that is the requirement to register. That threshold of small suppliers is looking at that $30,000 number. That's where I'm going to end this video. When we come back, we will discuss input tax credits. I've already mentioned them several times. When a business pays sales tax, they get those ITCs they can use to reduce the payables of their remittances because they've already paid some sales tax out. Thank you for your time. See you in the next video.